Welcome everyone to our issue briefing, From Token Assets to a Token Economy. My name is Sheila Warren. I'm the head of blockchain here at the World Economic Forum. To my immediate left is Jeremy Allaire, the founder and chief executive officer of Circle. And at the end of the panel is Neha Narula, the director of the Digital Currency Initiative at MIT. Welcome to both of you.
Thank you.
Thank you. So blockchain tokens are being created, specifically security tokens, that allow real property, corporate securities, and other types of assets to be traded on secondary markets. And we're hoping to explore today, how can tokenization, as this phenomenon is called, make illiquid assets more accessible without creating new financial risks? Is it true what we're hearing in the press about the democratization of assets and asset ownership that tokenization can bring? So I thought we'd begin. I'll remind the audience first that if you want to follow along, you can use the hashtag WEF20, WEF20. My first question I'll direct to you, Neha. What does it mean to tokenize an asset? What is this concept? Can you break it down for us?
Sure, Sheila. So with the advent of cryptocurrencies, people realized that there's a way for people to digitally hold an asset. So just the way you would hold a paper dollar or a stock certificate, you can digitally hold a representation of that. And this is a little bit different than holding it through your bank or a trading firm like E-Trade or Fidelity or Charles Schwab. It's a digitized version of that asset. And as such, it's wrapped in this programmable layer. And we can build really interesting applications on top of that. And that's what we're here to talk about today.
Maybe, Jeremy, you can give us an example of this, maybe real estate, fine art, et cetera.
Sure, absolutely. I mean, there are a lot of projects that are trying to do this, and they run the gamut from very simple, taking a type of, say, financial asset that we use or are familiar with in everyday life, such as actual dollars themselves, creating a token that represents a dollar, and then being able to get the benefits of a digital dollar, to more scarce assets like gold, where basically ownership positions in gold are made available as tokens that then you can purchase and then trade them on secondary markets. And then it really starts to go out into more complex type of assets. So, all the way at the end, slices of ownership in a piece of art, or very recently, a really popular NBA star tokenized or is in the process of offering a token that gives you a investment in their future earnings. And so it allows people who believe in that, say, player to invest in their future earnings, all the way to maybe in the middle, traditional property like real estate or physical property, where in the past, kind of owning a piece of a property has been difficult. So tokenization is being applied in all of those different types of areas. One last example, which I thought was interesting, just given the forum agenda this year, a company in Australia just recently launched what are called air carbon tokens, which are effectively tokenized carbon credits that then are tradable in these emerging secondary markets as well. So really a wide range of different types of examples that are emerging.
Yeah. So to make this really concrete, as an example, would you say I could, for example, own a piece of a Warhol? So the kind of asset I might never be able to own myself and put up in my home, I can take a fraction of that, I can fractionalize that physical asset digitally, and I can then trade that piece of the Warhol on a secondary market. And that is independent of who actually owns that Warhol in the physical sense.
I think that's right. I mean, I think part of what makes blockchain interesting for these uses is, you have a record-keeping system that is a sort of immutable record-keeping system. You have a transaction environment where anyone can transact with that around the world. And then you have contracts. And so, for example, a slice of ownership, that's sort of a contract you have with the underlying asset. All those things become possible to be put on a blockchain, and therefore transferable, tradable, investable, and so on.
So it sounds like, Neha, there's an opportunity here to take otherwise illiquid assets and enhance their liquidity in a way that is transparent. Could you say more about that?
Sure. I think it's really about streamlining. It's taking a process that was previously very onerous, was quite manual, quite analog, and turning it into something very digital. So once you do this, it becomes much cheaper, much quicker, much faster to actually break down a Warhol into 1 million different tokens, for example, and to do that for thousands of paintings around the world. You can have exchanges which digitally transact in these tokens and assets so that people can move them around and trade them seamlessly 24/7 instead of having to wait until the banks are open. However, there do come some challenges with this. There are some reasons why it's a little bit difficult to do this in the analog world right now, and I think some of those risks will carry over into the token world too. So we have to watch out for that.
Say more about that. What are some of the risks and challenges here?
Sure. Well, I think a lot of the reason it's so onerous to do this in the non-tokenized asset world is partly because of regulation, and regulation that's there for very good reasons. We want to have consumer protection. We want to have market integrity. People who are issuing assets should disclose information about what exactly those assets represent. And we want to make sure that those assets are really tied to their representation in the real world. And so this requires some amount of monitoring, some regulation, and I think that we're still writing that law for the tokenized asset world.
Maybe to add to that, it's always interesting to try and find metaphors for this, and the phrase that you used in the introduction, which is this going to democratize access to capital or ownership in things? And I think that's what gets us all very excited about this, and I think that's very real. If you use the example of, say, other internet platforms, right? It was hard to imagine, for example, that anyone who made something in the world would be able to plug into a global marketplace and distribute it to any other person anywhere in the world in a matter of days, so to speak, and where the buyer and the seller would never know each other. In fact, it's sort of anonymized in a sense, but there's sort of risk and reputation systems and efficient, logistics and discovery platforms that made it possible for a very, very, very long tail of product creators to reach consumers. Or in transportation, we have the example of Uber, where anyone can be part of a commercialized transportation system, hospitality, and so on. You have these platforms that are essentially marketplaces of two sides. And we have that, of course, with capital today. We have capital markets, and capital markets are, you could argue they're very efficient. You have the New York Stock Exchange, NASDAQ, but who participates in those is really limited, right? It's basically, thousands of companies out of millions of companies, and the ability to access capital as a startup, a small business, an entrepreneur, all the way as you grow, is limited. And so we don't have markets in the same way that we have these open marketplaces in commerce and transportation and these other things. We don't have those markets in capital or in ownership and investing. And so I think the promise of this is, can we actually create capital markets that are as open and global and as what we have in e-commerce and these other, and even in realms like content and content publishing and sharing? Can we have the same kind of experience? And back to the earlier point on regulatory, our regulatory regimes on this are very siloed. They're very country specific. I mean, there are some standards around this, but they are very siloed, and it's very hard to grasp the idea that a farmer in India might be tokenizing the future yield of their property and offering that in a global marketplace, where an individual investor who's 19 years old who says, I'm interested in this, or a basket of things like that, and can just get to that in a marketplace as efficient as Amazon or Alibaba. You can see how that would be possible, but there are so many rules and policies and risk management and other things that exist that have to be dealt with.
Mm-hmm. And it sounds like the lack of global alignment, regulatory alignment in these areas is a challenge. And I think it's interesting to kind of compare and contrast, as is often done in the blockchain space, to the early days of the internet, when we really weren't faced with global disharmony of regulation. I can only imagine when taxation authorities around the world are paying attention and kind of thinking about all of this as well. What are some of the other challenges? Are there cybersecurity risks with the tokenization or the liquidization of these kinds of assets?
Yeah, definitely. This is new technology. Blockchain technologies really only existed for 10 years total. We're writing very complex protocols, the software is pretty risky, and it's operating in a pretty adversarial environment. So there have been a lot of bugs, a lot of vulnerabilities and problems with cryptocurrency technology that's being used to build these tokenized asset systems. And so I think we really have to be careful. We really have to be very cautious. We also have to think about things like standards and best practices. One of the really exciting things about this technology is that it allows us to innovate in so many different areas around financial assets. For example, custody. Now we can think about custodying assets in a very different way, where we can spread out the risk of who actually has control of the asset. However, we haven't really figured out exactly what the standards should be for these new types of custodians. So there's a lot of challenges to figure out with best practices, with cybersecurity, definitely.
I would add to that as well. The technology that sits behind a tokenized asset, as we talk about it, is often referred to as smart contracts. Now these smart contracts are neither contracts nor are they smart, but that's the phrase we use, smart contracts. But what it really specifically means is that you have this record, and say the record is a token, say, representing ownership in a piece of art, or whatever that example would be. And then there's a piece of code that's been published onto the internet. And that code is the smart contract. It sort of governs the rules of movement, of ownership. And there's more and more things that you can put in that code. When you think about ownership, ownership is also just a contract. So the fact that I own a share of, say, a Delaware corporation, well, actually, the share, the certificate is not the really important part. What's important is there's a very extensive corporate constitution. There's a very extensive shareholder agreement, share transfer agreement. Those exist within a regulatory framework under US securities law. So there's a lot of English language, so to speak, at least in the United States. And there's a court, the Delaware courts and the US federal courts, that enforce that contract, right? So with tokenization, I think the thing that many people are excited about is, well, how can we move more and more of the things that are done by people, processes, by law firms, by accounting firms, by the sort of fiduciaries that sort of do these processes, insurance, all these, how can we move more of that into code so that it's actually able to work in a global way, in a very transparent and efficient way? But that creates a lot of new challenges, both because the technology is very new, and so you're sort of relying on the execution and enforcement of contracts by machines, not humans, and that's a choice we're readily walking into as a society. But also, I think it gets into there's a real lack of kind of case law. So there are states like Illinois, Delaware, Wyoming that are passing laws that say you can put more and more of different aspects of your corporate form on a blockchain in a smart contract, but there's not a lot of case law to say, what happens when this or that happens, and so that the sort of merging of real world contracts and these digital contracts is still quite new and untested.
It's also, I think, it intersects very cleanly with property law. And so there's this concept in property law, the very common law concept of the bundle of sticks that we talk about. And so we say that bundle, if you hold all the sticks, then you have full ownership of an asset. But you can also create different kinds of sticks that you can then give away. And one example that's often used is merchandising. So you have a celebrity or someone whose likeness is considered valuable or can be monetized, and then some of those sticks actually go to other shareholders or stakeholders in a particular market that are then monetizing that likeness or merchandising it. We're going even further here, and we're talking about taking a fraction or a portion of even that likeness, let's say, that celebrity likeness, and then the AMB example that you gave, I think, is a good one, and dividing that up and democratizing ownership of that likeness or of that even celebrity or their career, that kind of thing. But of course, there's a threshold question. This is what I find so interesting about this. Is we talk a lot about, one of the phrases that's tied to blockchain often is financial inclusion. The other one is democratization of assets, of asset ownership, et cetera. but someone still has to want to own the underlying asset. Right? And so I'm curious, like how far are we from the example you gave of the farmer in India who actually could take their crop yield, let's say, and securitize that via tokenization? I mean, how would you even begin to access that kind of a market creation as an average citizen?
Yeah, I mean, I think we're still a good ways off, but maybe not that far off. You know, they're sort of in this sphere. There's sort of different layers that have to be in place. So we have like the blockchain technology itself, which I think of as like these new operating systems for the internet that deal with these fiduciary trust applications. And so there's huge advancements happening there and in that technology where it'll be scalable and usable by hopefully billions of people in the coming years. The second is in order to transact, like in that example, presumably, the people who would want to own some of that need a way to move value into that contract. And so they need a stablecoin in order to do that. So you need essentially versions of money that also run in this code environment and can be transferred. So the growth of stablecoins is a precondition to the growth of tokenized assets. But that even if you use that India example, you know, that farmer in India needs to be willing and able to accept a stable coin and be able to use that stable coin, say, to pay their employees or to purchase bread at the store. And is that a dollar stable coin, or is there a market that converts between dollars and, you know, rupee stable coins? And so there's like think of it as like a market infrastructure layer that kind of needs to exist before you can even utilize and invest in a token like that. But all of those things are sort of happening in parallel, and there's some point, I would say, in the next 2 to 3 years, where they kind of converge and where those become much more realistic for people to execute on.
So it sounds like from a tech stack perspective, we're making rapid progress. From a policy stack perspective, if you will, we might be further off. What's your take, Neha?
Yeah, I would like to offer an alternative vision. I think oftentimes when we talk about securitization and tokenization, we take the fact that it must be implemented using blockchain technology for granted. I think the power of what we really have here is not necessarily the fact that it's implemented on a blockchain, a shared database, but the interface to the asset. We've changed the interface to the asset, so now we can program around the asset. The asset has an API. And we've made that asset more liquid. We've exposed it to secondary markets, and we've made it so that people can hold it quite easily. To me, this doesn't require blockchain technology necessarily. And I think if we sort of remove that component, if that's the way that things end up sort of evolving, we could see something happening much faster, actually, and integrating with our existing payment system and financial system.
So what do you see as the barriers to that vision that exist right now?
I think the barriers really are regulatory and also incentives about the existing market players. The existing market players so far have not really been motivated to innovate in this space, to supply this API. It doesn't really require technological innovation, but I think that when it comes to the mobile apps we have on our phone, my banking app or my stock app is probably the least sophisticated and the least interesting to use. So we really need to bring some of this innovation into the financial market. And if that's done by opening it up to tokenized assets on secondary markets, then I think that's great.
I would add, on the policy side, I agree that there are these very significant policy barriers, and in particular in these cases where you're talking about someone being able to purchase ownership in something, you're getting into securities law, and securities law exists to ensure that the issuers of those, say the person who's representing ownership in, say, their salary or a piece of art or property, that they in fact are not committing fraud, that it's real. So there's sort of disclosure requirements that you have, and those are designed to provide protections to investors, but also within private markets, and we're essentially by going down the stack and saying, hey, we're going to open all this stuff up to all these individuals. There's this distinction between, a sophisticated investor or an accredited investor and an unaccredited investor, which in current law is essentially rich people versus people who aren't rich. And that's not a very good distinction when you think about this. But you have to look at what are the real risks are there's fraudsters, and people can't have enough irrelevant information to be able to make sound investment decisions, and it's risky. So that's why venture capital funds aren't available to the average person to invest in. Now, I think if coming back to the example of these earlier internet platforms like e-commerce marketplaces, they created, or even Uber as well, they created self-regulatory schemes, essentially, that ensured that the information asymmetry that exists is resolved. So I know because of the risk and reputation system, I trust the risk and reputation system of this marketplace, and it's got a track record. I'm willing to buy from this random manufacturer in China or wherever they are. And the question I have is, can the technology and innovators in this space come up with technological solutions that deal with those fundamental risks, the risks of disclosure and other things, ahead of what policymakers might say, and get it right, and do it actually better than how we're currently doing it through things like SEC registrations.
Yeah, I would just like to add, I'm very excited about applying this technology to the field of regulation. Actually, this technology is by its nature a self-regulating technology. Instead of having rules encoded in laws, we have it encoded in software. And it's quite interesting to see the way that we can actually embed some of these policies into the software itself, automatically deducting taxes, exposing who something's going to, and making sure that they're on an appropriate list or something like that. The software can actually enforce this for us. So there's a certain class, a certain type of regulation and policy making that I think can be moved to the software. And then the rest, we are going to have to work with policymakers and regulators. We can't just let the industry self-regulate, unfortunately. It's got to be a multi-stakeholder conversation.
And international.
Yeah.
Because these digital assets, they exist, once they're on the internet, they exist everywhere an internet device can connect to the internet. And so the reach is inherently, global.
Sounds like to really realize the advantages here, to really achieve this democratization, for example, we're going to have to take a global multi-stakeholder approach and ensure that there still is a role for authentication.
Yeah.
Whether we are able to outsource some of that to the technology, there is still going to remain, is the Warhol a Warhol
Sure.
kind of role, and that is something that would be very difficult to ascertain using simply some kind of algorithm.
Right.
Thank you for your comments. I'd love to open it up to the audience if there are any questions from any of you. Please.
What has become?
Oh, one moment. Sorry, we'll wait for a microphone. Yes, thank you. There we are. Thank you.
What became of the idea of sort of an algorithmic stablecoin, sort of like the way Basis was going to do it? Subsequently, I haven't seen any big projects in this area.
Great question.
So there's actually a huge project in this area called MakerDAO. So for those of us watching along who might not know, the idea behind an algorithmic stablecoin is that instead of being backed one-to-one with that asset being held in a bank account, for example, algorithmic stablecoins usually have two different types of assets that trade in relationship to each other. And the algorithm is designed in such a way that one of them maintains a relatively stable value. So the goal of the algorithm is to keep this asset pegged to something like the US dollar. Obviously, when you hear this, you should be a little bit worried. It's very difficult to get these algorithms right on the first try. This is the type of monetary policy that bankers engage in, central bankers engage in at a pretty high level. But I think it's very interesting to think about algorithmic monetary policy. The risk with these types of coins is really what happens at the edges of the system. What happens if one of the assets really experiences a black swan kind of an event? Can it maintain the peg?
Exactly. Please.
I'm still struggling slightly to understand, or to maybe I'm not being imaginative enough to know why, for example, anyone would want to buy a token of a Warhol. You can buy shares in various art companies. If you're not going to actually physically own the product, if you want to buy a little bit of a real estate, you can already buy derivatives in house prices in many countries. So we have lots of these things that they're often not very successful. So I'm still really struggling to see where the demand for this. For poor people, they just want to save a little bit of money in the bank, really. It's not really the thing that they're itching to do, is to have these weird and wonderful investments.
Yeah, I'm happy to take part of that. I mean, I think you make a really strong point, which is not every person wants to be speculating for their long-term savings strategy, right? I think the flip side is that diversified alternative investment strategies are significant. So you can imagine people who, if the liquidity and the access to these types of assets, more and more types of assets become available, there are going to be people who bundle those and create the equivalent of what we think of as funds, and that those become investable and they have yield characteristics that are interesting to an individual who wants to think more passively. So I think there's the mechanics of the actual individual asset, and then there's how would that actually ultimately be accessed by a person. There certainly are people who are going to be passionate about something really specifically, like a sports athlete. They may be very, very passionate, or the popularity of a cartoon character, or whatever it would be. And so people who have deep passions and interests might find that interesting. I think for me at least, I'm interested in more mundane examples, which is what we think of as private equity. So private equity is not something that's accessible to a broad class of investors today. It's largely only accessible to the very wealthiest. But an enormous amount of the innovation that happens in the economy and the growth in value comes through private companies that are started and grow. And so it seems like a place where you really could, both for the entrepreneurs that are trying to form capital and for the investors who are wanting to access that class of alternative investment, to give them a more efficient way to do that, and then to do that on a global basis. So I think more mundane, but also I think...
Just peer-to-peer lending, though.
No, I don't think it's just peer-to-peer lending. If a company is issuing the equivalent of equity, and that's ownership in the company's cap table and its future earnings potential and whatever stake that you'd have in that business would yield, that's very different than a person giving a loan to a company.
I think the flip side of this as well is that, and this I think has still yet to be fully road tested in my opinion, but it's this idea, your farmer from India idea. The idea right now is, yes, you could buy a share in sort of a bundled crop yield in the state of Karnataka, kind of asset, right? That has been created, there's speculation on that all the time, but the level of disengagement, disintermediation from the farmer himself or herself, there's a huge layer in there. And so this is about an individual being able to actually tokenize their own value, their own product, their own whatever it might be. Now, again, there is a leap in there. And that's what I'd mentioned earlier. Who would want, please, yeah, wait for the microphone. Yes, thank you.
Aren't these just standard economic agent problems? The reason a sports person can't tokenize their future earnings is because they could just sit with their feet up once they've taken all the money, unless you have a contract which forces them to train, and you have a huge amount of case law, which you can't, because how do you know the difference between faking an injury and actually getting an injury, and who's going to be responsible? The reason people can't generally get loans or equity in themselves is because there's a moral hazard there that if you get the loan and then you sit with your feet up, there's going to be no return. And so these are fundamental economic problems. They're not token problems or blockchain problems. They're actually problems of economics.
I think we absolutely agree with that. I think, as Neha indicated, it isn't that blockchain is in any way solving that problem. It is a mechanism, and blockchain is one example. There is a mechanism for outsourcing some of that agency to the technology, whether that's a blockchain or other. And that is kind of what is, I think, being explored here under the surface.
I would just add one last comment on this. I think it was very hard for people to imagine the long tail of content or of retail, of commerce that the internet brought. No one would have imagined watching cat videos would turn into a massive business, that there would be millions of content creators that would create a completely new kind of distribution model for content, or that it would be we thought, oh, we have big box retail stores, they have everything we'd ever need, but we never imagined that there would be 1 million or 2 million product creators that we would all have access to, and we'd see the benefits of that. So the long tail of capital and the long tail of things that are investable with capital is quite large, and it's hard for us to imagine what an efficient global marketplace for that would be, but I think that's where we're trying to point this.
So I'd love to close us by asking each of you to just give a final thought and along this topic. Where do you think this whole topic area is going to be in the next 5 to 10 years? Feel free to differentiate. It's a very long time horizon in our world.
Yeah, I would actually just kind of come right back to where I was, what I was just talking about, which is I see these kinds of new open global marketplaces that exist for tokenized access to capital. I don't think these are necessarily like centralized in the same way that Amazon or Alibaba are, but that there are many, many different marketplaces that are connected together and that individuals can and firms can participate in those. That the world will look, that world of capital will look much more like the world that we see in internet commerce today.
Yeah.
Yeah, I mean, I think we're conducting a grand experiment right now. It's certainly the case that a lot of things which we think might benefit from tokenization or chopping it up into little pieces and making it available don't actually benefit from tokenization for some of the reasons that the gentleman just indicated. However, we haven't really been able to do this before. We didn't really have the technology in place, the systems in place, the infrastructure in place for someone to even try to do this. So I think that in the next 5 to 10 years, we're going to see a lot of experimentation. Some of these are going to fail dramatically, but there might be a few that really and truly do expose some lack of some sort of something missing from the real world that we're unable to accomplish that we can accomplish with this technology.
So stay tuned, in other words, and let's see what happens. Thank you both so much. We appreciate your time today.
Thank you,
Thank
Sheila.
you, Sheila.